Seema Shah is back with us, Chief Strategist at Principal Global Investors. Seema, when you look at the way the equity market seems to be optimistic and the data that we continue to cruise through, what's the best explanation that we have here? Walk me through the way you're viewing some of these companies that are driving the equity market that seem to be doing just fine during this economy.
Right. Well, I think there's three reasons why you're seeing that very significant dislocation between markets and the underlying fundamentals. So one is that during March, when we were seeing those drastic falls in markets, they were making some really significant downward revisions to earnings and economic forecasts. So it's very difficult to be negatively surprised at this stage. The second thing was positioning, right? As we saw everything being kind of de-risked, now positioning looks okay and actually kind of it helps to the upside. And of course, the third thing was that central banks were in play, central banks and fiscal policymakers. And now what we're seeing is when we look at the S&P 500, for example, the key drivers is really mainly the tech sector. And that makes sense to us, given that it's the large mega cap companies that are going to be outperforming. They also, with technology, have the secular growth story as well in their favor. So as you have people working from home, this looks like it's going to be a trend which is going to be here with us for the foreseeable future. And so all of this plays well for that part of the market.
Seema, should we think about the tech strength as this kind of corner of the market that is maybe getting overbid and frothy because it's one of the few places that's working? Or should we look at it as a sign that the stock market is telling us we need to rethink our descriptions of this period? If people are willing to buy $2,000 stationary bikes, $40 subscription passes, and businesses are spending on communication software and everything else, is the NASDAQ telling us that maybe our scenario is not as dire as we thought?
So it's a really good question. I think with technology, the way that we have to consider it is that, yes, it is looking very expensive, especially if you look at it relative to other sectors and certainly to history as well. And I think what that does tell us is that in terms of the magnitude of gains that we can expect, it's not going to be as high as it has been over the last few weeks. So that's going to start to slow down. But the thing is that as long as you have technology which has strong cash flows, it's got positive cash flows, most of these companies, they've got strong revenue streams. And of course, as I said before, they're really tied into the kind of secular growth story that we're going to be seeing going forward. So there is something to be said for technology. The only thing is that when you look at it from a market perspective, from the overall market, it's giving you an undue, almost an undeserved impression of how strong the economy is, or even how strong the market is. Because when you deep dive into the other sectors, actually it's not a very positive story whatsoever. And a number of sectors are actually still in a bear market territory.
When we look at the numbers and we try and connect this, right, to your point here, there's a lot of companies that still have really not even gotten bid up off the lows. I mean, airlines are still getting slammed. A lot of the consumer stocks are still getting slammed. But when we look at this data, there seems to be this difference between what's on paper and what's in reality, because if everybody's unemployed, but we're still getting help from the government, getting paid, what do those unemployment numbers mean? It's like, it's kind of like when you tip over glass yourself and then you catch it before it falls. It's like we shut down the economy, but then we saved it, and now we're kind of like, are we just like netting out nothing here?
I mean, yeah, almost. And I think one of the things that we are starting to think of is, what happens post-support, or even how quickly a government's able to lift the support that they've been providing. What happens when they do that? I mean, it suggests that actually bankruptcies are still going to be really high, right? So even if you have got help, the Fed is still buying, either it doesn't change the fact, that you're a bad credit, right? So bankruptcies are still going to increase, which means that it's going to be very difficult for companies to be in a position to rehire workers. So what we're starting to think about is, once governments start lifting some of that support, you're likely to see an additional surge in unemployment at that point. So the government help that's been given doesn't mean that the economy is particularly strong. It's certainly taken out the negative sting, but it doesn't mean that the picture is very rosy.
It's not rosy, but definitely. It's not maybe depression either. What does this mean in terms of how to make decisions from an investment standpoint? Do you have to just hide out in the safety stuff? Does that make sense if there's still part of this economy functioning and the support? How do you kind of reconcile the overall pain with the backstop provided by policy? What does that mean in terms of what you want to own?
So I think the first thing is it's really important to be invested. If you just think back to the global financial crisis, if you'd invested at the bottom after 10 years, you would have had incredible gains. So there's always going to be opportunities, but you really have to look at which places have got the strong balance sheets, which ones will benefit and almost have pivoted to gain from the kind of the change in environment they were experiencing. From a secular perspective, from a sector perspective, as I said before, we still really like technology. We think it's important to be in the defensive play still. So mega caps is your best positioning within this because they're the ones who are large enough to deal with the challenges that we're being faced with. At the same time, though, as long as we have central banks in play, it does mean that there is continued support for markets. Right? We may see renewed falls as you start to see weakening data come kind of Q4 type, but ultimately there is still a positive movement. So within that perspective, you need to have some cyclical exposure, but you just got to be very careful. And this is where, again, active management is really important because you have to know what you're investing in. It's not enough to just be focused on indices.
What do you see in the early signs of economies trying to come back? Seema, are you a believer in numbers from China? Some of the numbers early about auto sales look pretty good in terms of a rebound. The China Association of Automobile Manufacturers says that they were actually 0.9% higher than a year before in the month of April. I mean, is there a potential here that there is a potential kind of rebound that maybe is not a V, but is something fairly speedy? Is there any evidence for that you see?
Well, I think we can say it right. There is a rebound, which makes sense if you're starting from a very, very low base. The next quarter is always going to show some kind of pickup. The thing is that, right, when we hear about the retail sales from China, actually it suggests that there's continued household caution, right? So people are scared about going out in case they catch a virus, but they're also really concerned about household finances. So I'm not sure if that picture entirely ties together, but it does give an indication of what we should expect going forward. And as you said, stuff like the leisure activity, restaurants, airlines, they're going to struggle to pick up, not just in Q3, but you're looking at even past 2021 until we have a position where social distancing is no longer part of our lives. So I would treat a number of these sectors with major skepticism for a prolonged period.
Seema, what's the most important metric to look at if you're trying to figure out the velocity at which this economy can come back? What's it going to be? Is it going to be employment data that's now gotten so skewed so deeply? Is that really going to work? Is it going to be looking at signs of pollution measurements or traffic? What is it going to be that's most important to get a pulse on the comeback?
Yeah, unfortunately, what we're facing now is that the typical economic data is either very backward looking and it's not really speedy enough to catch up with what we're experiencing on a day-to-day basis. Now, unemployment jobless claims has been really useful up till now, but unfortunately, I think their usefulness is going to be fading out as we move to lockdowns being lifted. It's going to be a little bit distorted. So as you pointed out, the high frequency indicators are going to be what's important. So pollution, what are the traffic levels? Looking at stuff like Starbucks, how many of them are reopening and how well are they doing on a revenue basis? What are you reporting from that perspective? So it's those high frequency indicators that are going to give us a better idea of how confident households are about going about their business again. Until they are confident to do that, we should not expect a very strong economic recovery.
All right. And Starbucks, 85% of stores say they're going to open up maybe by the end of this week here. Seema Shah, great to catch up. Always a pleasure talking the big picture as it is increasingly difficult to figure out. But maybe some early signs here that the bottom perhaps is trying to turn. Seema Shah is a chief strategist at Principal Global Investors, joining us from London this morning.